People at Databricks, they seem to have a pretty nice holiday. Valuation going up. You've been on the show before talking about just the number of software companies that are private, like about 90% or so are private. These valuations, they just keep surging higher. What does that mean for investors of both the private markets and the public markets?
Yeah, look, I think it's the number one question that we're all grappling with, whether it's public or private, are the valuations that we're seeing within the artificial intelligence value chain, from the power side to the application layer. And I think the biggest thing for us when we look at valuations is whether or not they are supported by fundamentals and whether or not they're supported by earnings growth. So on the public market side, what we've actually seen is that valuations for these hyperscalers and the areas where value has really and returns have accrued over the past 3 years have actually contracted because earnings growth has more than doubled for that cohort. And when we look at the private market ecosystem, I think there's a tale of two cities going on, if I can quote, English lit from high school. And we are starting to see pockets of isolated froth in certain parts of the earlier stage in the private market.
Let me ask you that. If you see isolated froth, does that make the public markets more attractive because you have more visibility into their business? And in general, I mean, we're talking about 32 times over here for Databricks. In general, they're actually cheaper than a lot of their private market counterparts.
Right. So I think that the biggest thing for us is where we are in the value chain and what public markets can provide versus what private markets can provide. And usually when we think about tech evolutions, there's the infrastructure stage, and then we progress to the application stage. And so far, we've seen a lot of value accrue to the infrastructure stage. Think semiconductors, think the hyperscalers, think the power infrastructure players, utilities. But we actually think we're on the precipice of moving towards the application layer. So this shift from software as a service to services as software. So we actually see meaningful opportunity within private companies. It's just that the froth that we're seeing, it just means that you need to be selective.
But that's the same as the public markets now. That's what everybody's saying about the public markets.
But that's okay. Like, I think that need to be selective is just indicative of where we are in the artificial intelligence life cycle right now.
Speaking of where we are in the artificial intelligence life cycle, you're out with a new report looking at the AI trade that a lot of people think is a bubble. You say it's not going anywhere. Now, here's one stat that I thought was fascinating. According to your research, the AI trade right now, or AI build out, whatever we want to talk about it, is about 1% of GDP. We always talk about it being a driver, but you say it's about 1% of GDP. If you look back at other revolutions in technology, the rails, electricity, et cetera, it was about 2 to 5% of GDP. So does that mean that there's a lot more to go when it comes to this build out? And these thoughts of a bubble are silly compared to how little of GDP it really is?
Yeah, look, it's a great question. I think when we think about capacity build out and bubbles, there are 4 things that we tend to look at. In terms of our framework to whether or not artificial intelligence is in a bubble, we look at whether or not there's excess capacity or overcapacity and overbuild, what valuations look like, and whether or not fundamentals justify that, and also whether there's excess leverage in the ecosystem. And when we put those components together, we're not yet seeing signs of excess capacity being built. We're not yet seeing signs of excess valuations. They seem to be justified by the fundamentals. We're not yet seeing signs of excess leverage. But on the capacity point, I think the biggest thing that I would mention is this. We actually believe that there's probably room to go because we're still in a compute-constrained and power-constrained economy. The demand, it's very different than what we saw in the late 90s to early 2000s, where there was a lot of fiber optic cables that were not being utilized. We are still at a point in time right now where data center vacancy rates are at multi-year lows, and we're still seeing demand far outstrip supply. So we think that investment cycle has years to go.
All right, your report, fascinating report, by the way, kind of broad ranging. Another part of it is about inflation. So a lot of talk about inflation. We're expecting a Fed rate cut coming up this month, and that's with inflation pretty well above that 2% target. Why is inflation so important to investors? It doesn't seem to be stopping the bull market. It doesn't seem to be stopping us from hitting new record highs. It's valuations that are impacting the market, not inflation right now.
I think the biggest thing for us is that the macroeconomic environment now is very different than what we've experienced in the post-GFC to pre-2022 timeframe. We have Inflation likely is going to peak, sometime mid next year and taper off, but it's likely going to stay above the Fed's expected target. We're likely going to see, therefore, rates stay a little bit higher for longer. They're going to come down, but they're going to stay higher for longer than what we've seen historically. And we're going to see higher for longer rates, potentially stickier inflation at a time of moderating economic growth. What that means is that the building blocks of a portfolio need to shift alongside that to ensure that those returns are durable.
Inflation protection is what you're talking
Inflation protection primarily, because when we see these periods of time where rates are elevated and inflation is elevated, bonds don't protect in the same way. We actually have seen periods of time where bonds are more positively correlated with stocks, so you need to be able to add that inflation resilient income. Infrastructure, real estate is an example of that.